going to calculate the stock price for Braemar Hotels. And the first thing we need is the market cap, which is 114 million. And then we need a stock price, which is $3.40. And now we can figure out the shares outstanding. We take the market cap divided by the stock price, and we get 34 million shares outstanding. Next, we need the free cash flow. And the best way to calculate the value of a company is to estimate future free cash flows and then discount those numbers back to today's values. That's exactly what we're doing in the model here today. So we'll just pull free cash flows from Yahoo Finance. And then next is net income, and that can be found on the income statement, and that's the profit and loss for a given year. So they didn't have much net income in 2018 and 2019. And last is revenue, which is also on the income statement. Now we need to look at the capital structure of Braemar Hotels to figure out the discount rate we need to apply to the future cash flows. So we're going to pull the interest expense from the income statement, and that's the interest this company paid on its debt. And then we'll go to the balance sheet to see how much debt they paid. They have 500 million of current debt. That's debt due within 12 months. And they also have about 500 million of long-term debt. That's debt due after 1 year. And this is a REIT, so REITs don't pay interest or taxes. Since 90% of the profits of a REIT get paid to the shareholders in the form of dividend, the shareholders pay taxes on those dividends, not the actual REIT entity. It's shielded from taxes. So the 5.15% interest they pay on their debt is the cost of debt. And you can see 90% of the capital structure is debt, which is not good. That's highly leveraged, and that could be a risky investment. Let's look at the beta. It's 2.75. Beta is the volatility of the stock. It moves almost 3 times as the market, so it's pretty volatile. So the WACC is the weighted average cost of capital. That's a blend of the cost of equity and the cost of debt, 6.93%, and that's what we're going to discount the future cash flows by. So we estimated cash flows in 4 years, and then we did a terminal value, all years beyond year 4. And it's really low, the number, the terminal value. And the reason that is because I revised my model to give a haircut to companies that have a lot of debt, such as this. So that's taken into account also. And I also had to redo my model to try to analyze REITs, which is really difficult to try to value a REIT. And I'm getting a little better at it the more I do of it, but they are a little hard to figure out. So anyways, we're gonna present value these numbers that we calculated up here, and those are the present value. So the value of the company, according to the model, is $158 million, and we divide it by 34 million shares. We get a stock price of $4.70. So it is trading at 340, so it is a buy according to the model. It's trading at a 28% discount. If you look historically, they've been trading much higher than intrinsic value. So stocks can trade higher or lower than intrinsic value. The stock price moves on the demand of the market. If more people want to buy a stock, the price gets bid up. And if more people want to sell a stock, the price gets pushed down. So everyone has their own opinion on the value of a stock. This is my model and my opinion. So thanks for watching.